So the first thing I'm going to do is talk about how I find great value opportunities. Then I'm going to talk about evaluating companies, how we go through the process of deciding which are the good quality companies and which aren't. And then at the end, we'll talk about whether or not anything is cheap right now. By the way, hands up if you think the market's cheap? Anyone? Okay, okay. Keep your hands right up for a sec so I can see who you are. Okay, put your hands down. Hands up if you think the market's expensive. No one's put their hand up. Okay, hands up if you don't know. Very good, that's the majority. Okay, isn't it interesting that the majority don't actually know whether the market's cheap or expensive? And I have a view, it might not be right, but I have a view, and yet we're all investing in the market. So arguably we're investing without full information. This idea that markets are efficient, the idea that markets take everybody's information about companies and correctly factors that into daily prices is clearly absurd on the basis of the findings of one question. Okay. So the first thing that we do is we create a framework, and what I'd like you to do today is to think about what framework you use to invest in the stock market. We have a framework that has a couple of rules. The first rule is that we think about companies, not stocks. If you were going to buy a local business, a newsagent or a butcher shop or a bakery or a small local business, what are the questions that you would ask yourself before making a decision to invest in that company, that business? What are some of the questions? Any ideas? Any thoughts? Is it growing? So is there growth in what? Number of staff? Profit growth? Revenue growth? Yes. Okay, what else? Growth in the market? Is the market that they're catering to, is that market growing? That's interesting. There's a declining ratio of 49-year-olds to 69-year-olds. So the number of 69-year-olds in the world is increasing and the number of 49-year-olds is declining in proportion to the number of 69-year-olds. And what does that mean? Well, 49-year-olds are savers and capital accumulators, whereas 69-year-olds are dissavers. They're selling assets to generate cash to pay for healthcare and lifestyle and retirement and those sorts of things. That has all sorts of implications for different businesses as well as the stock market and house prices. Okay, so that's a good one. Another one. Up the top here. Someone up here. Yep. Positive cash flow. Does the business have positive cash flow? The money that it generates in profit is not necessarily the profits that you can take to the grocery store, the cash profits. So does it generate positive cash flow? That's a good one. Any others?
Is it debt heavy?
Does it have a lot of debt? Is there already debt in the business? If we're going to borrow money to buy this business, we don't want a business that has a lot of debt. Hopefully we're not using debt to buy the business, and it would be even better if it didn't have debt in it at all, and we'll talk about that a little bit later on. Yeah. Competition, fantastic. What's the competitive landscape for this business look like? If you're going to buy a butcher shop, it's not much help if there's 5 other butcher shops within 250 or 300 metres of yours. It's going to be a tougher environment to operate in and grow. You're going to have to make smart decisions every hour about pricing your product. And it's going to be much easier if you had a business that was standalone, didn't have immediate regional or geographic competition. So the competitive landscape is an important one because it ultimately drives the profitability of your business. And what about the competitive landscape in 2 years' time or 3 years' time or 5 years' time or a decade's time? Is it going to be easier for competitors to move into this business that you're about to buy? Is it easy for competitors to come in, or is it really difficult? When we built Scaffold, when we had Scaffold built, we asked the developers whether or not, when they completed their work, we asked them how much they would charge to build it again for somebody else. And they said, we'll never do it again. It was the most complicated thing we've ever built. That's music to my ears from a competitive landscape perspective, isn't it? Because at least they're not going to build another one. Okay, so you want to think about the competitive landscape. Woolworth's competitive landscape is a lot easier to predict than Apple's competitive landscape in the next 10 years. It's much easier to work out what the competitive landscape might look like for Woolies than for Apple. Same for Google, really tough for Google. There are businesses where working out what the competitive landscape might look like in the future is much easier. And they're easier businesses to work out the intrinsic value of. So it's a great point that you made. Well done. One other thing. What else would you look at in buying a local business? The quality of management. Okay, so two people going to say the same thing. The quality of management. If I'm not going to run that particular business, who's running it now? What's their background? What's their CV look like? Are they any good at what they do? Are they trustworthy, honest, intelligent, energetic? And there's a terrific quote from Warren Buffett. He said, you want to invest with people who are intelligent, energetic, and honest. And of the three, the most important is the last. Because if they're not honest, their energy and their intelligence will see you very, very poor. Okay, there's one more point down here. Location. On the location of the business, the geographic location. All right, so are they going to get a lot of passing customers in the particular examples that I gave? That's right. Now here's an interesting point. This is the point I want to make. You all seem to know exactly what to look for in assessing a local business to buy. My question to you is this: why does all of that go out the window when you're buying shares? Why do you forget all of that when you buy shares? The most common question that people ask when they're buying shares, is it going up? What does that mean? It means you're treating shares like bits of paper that go up and down. You're betting on up and betting against down. That's no different to betting on black or red at the casino. And so you're treating the stock market like a casino. You are speculating and gambling and not investing. So what we like to do is think about businesses, think about companies, not stocks. Stocks are the things that go up and down on a screen. Businesses are the operating things underneath those shares, all the things that those shares represent a piece of. So the first part of our structure is to think about businesses, not stocks. The second part is quality first. We're interested in quality. We're not so interested in poor quality businesses, even if they look cheap. Even if somebody said to us, well, they're going to turn around, if they're a poor quality business, and I'm going to give you some examples of these today. They might be in your share portfolio, by the way. Does anyone own Telstra? I'm just joking. Okay, just kidding. Okay, so what we're interested in is quality. And now here's the thing. We're interested in a demonstrated track record. We're interested in businesses that have a track record of success. They've demonstrated that they're able to win. Now, what does that mean for new floats? Well, for new floats, it may mean that we don't buy it. It may mean we simply don't buy it because there's no track record there. But a lot of new floats, new companies listing on the Australian Stock Exchange, a lot of them have been in business for a while. So it might be that you can investigate how the business has performed in the past. Even though it's a newly listed company, it may not be a new company altogether. It might not be a new business. And often you'll find that where there are results going back 2 or 3 years prior to listing, the company is required to actually put those results up in their statutory accounts when they list. So you can look at historical results for the company. Okay. Once we've found quality businesses, then we look for value. So once we've found high quality companies, we then try and work out what they're worth. But we don't look at price. We're not interested in price. We're only interested in value. We don't let price tell us what something is worth. It is so easy to believe that the market is right. How many of you buy shares? You buy a share. How many of you have done this? You've bought a share and the day after you've bought it, it goes down. Hands up if that's happened to you. 2 hands over there. We've got a very enthusiastic stock market loser. Another 2 hands over there. All right, so we all do that. You buy shares and they go down, and some of you will sit there and you'll say, why does that always happen to me? The market's out to get me. You know, it's not. It doesn't care about you. It's not thinking about you. No one else is thinking about you. But what happens is as the share price goes down, you've done your research, you've investigated the company, but the shares are going down. The immediate conclusion, which could be wrong as often as it is right, the immediate conclusion is often the market knows more than me. Somebody knows something that I don't know. And it's easy to believe that. It's easy to believe that our investigations are incomplete, that our conclusions are incorrect, and the market is right. But I can tell you from experience, the market is wrong Often. It is often wrong. If it was right, Qantas, no one would buy shares in Qantas. No one would buy them because that is not a great operating business. Okay? If the market was right, ABC Learning Centres would never have traded at $7.40 or $8 a share if the market was right. And if those smart institutional investors were right all the time, then the institutions that bought shares in ABC Learning Centres at $7.40 would never have done so. The problem with price and looking at price is we let it influence our decisions. We let it eat into us and believe that the price is right and that our analysis is wrong. But if your analysis is right and the price goes down, what should you do? Buy more. You should actually back your judgment. It's always interesting. I think it's always funny watching people who shout about the stocks that they bought and how much money they made on the stock. And when you look at how much they actually bought, it was $5,000 worth of shares. I always think to myself, well, you really backed your judgment with that one, didn't you? Or a fund manager who puts 0.5% of their portfolio into a stock, even though they've done an enormous amount of analysis on it. Think about it. If they get it right and the share price doubles, they've only made 0.5%. So I'm going to suggest to you that we're going to have to do some fairly rigorous research and investigation before we buy a stock. Don't buy it and then go and do the research because the market seems to think something different to you. Make sure you do the research first. And here's the last rule. Only when all the conditions are met, do we invest. I'm often asked the question, Roger, you look for businesses with strong cash flow, you're looking for businesses that are cheap, you're looking for businesses that are good quality. What about this stock over here? Well, does that meet all the three criteria? Oh no, it doesn't meet all the three criteria is the response that I get, but I think that it's still a really good opportunity. Well, either have your criteria set and then follow them or don't. So there's no point in having rules if you're not going to follow the rules. We follow all the rules and only when they're all met do we invest. We're only interested in businesses of the highest quality. Those businesses have to be A1, A2, A3, B1 or B2. Now what we do is we take 37 ratios measured in point in time and longitudinally. This is what Scaffold does. And then we use those ratios. There's 700 calculations and they come up with those quality scores from A1 down to C5. C5 being the worst, and I can almost guarantee that someone in this room has a share in their portfolio of a company that ranks C4 or C5, the lowest possible score. Now what do these scores mean? The highest score, A1, has the lowest probability of catastrophe. It has the lowest probability of blowing up. It doesn't mean it won't. It could still blow up, but it's the lowest probability of blowing up. C5 has the highest probability of blowing up. Doesn't mean they will, but it's the highest probability. Okay, we're looking for companies with little or no debt. Now, just so you know, I can see many of you taking notes and that's totally fine. These slides will be online. You'll be able to download them from the ASX website. So if you find it difficult concentrating on what I'm saying and writing at the same time, you can relax. We're looking for companies with little or no debt. Charlie Munger, who is 2IC or was 2IC at Berkshire Hathaway, was often asked the question, what do you mean by this statement, little or no debt? And he would lean forward in his microphone in his typically curmudgeonly way and he'd say, what don't you understand about no debt? No debt means no debt. You'll be surprised that there are lots of businesses listed in Australia that not only have no debt, but the ones that have some debt have way more cash than the debt on their balance sheet. They're actually in net cash positions. There are lots that have no debt and there are many more that are in net cash positions. So the universe is not completely restricted. There are plenty of opportunities for us to build quality portfolios, A1, A2, A3 type businesses with little or no debt. The other thing that we're looking for is high rates of return on equity. And let me tell you, return on equity is, in my opinion, the single most important ratio in assessing the performance of a business. Some people will tell you it's return on assets. But where the company has no debt, return on assets equals return on equity. They're roughly the same number. So return on equity is really important. Why is return on equity so important? Well, because some fairly simple arithmetic. If I buy a business, if you buy shares in a company, any company, doesn't matter what it is for this example, if you buy shares in a company that generates a 15% return on equity, and you buy those shares on a PE ratio, price earnings ratio of 10, and that company keeps earning 15% return on equity every year, and it pays no dividends, it retains all of its profits, and this is the caveat, it continues to get 15%, not only on the old equity, but on the new equity that's been retained, the retained profits. So it gets a 15% return on equity and a 15% return on incremental equity. So it keeps getting 15% return every year on its equity, and it pays no dividends, it retains the profits, it gets 15% again. You buy the shares on a PE ratio of 10, and in some future year, 2 years, 5 years, 10 years, 15 years, it doesn't matter. You sell those shares on a PE ratio of 10. What will happen is the equity of the business will grow by 15%, and the profits of the business will grow by 15%, and the shares will go up by 15%. And if you sell them on a PE of 10 and you bought them on a PE of 10, you will make 15% per year. So if you buy a business with a 15% return on equity and it pays no dividends, and you buy it and sell it on the same PE ratio, you will make the same return, buying and selling the shares, as the return on equity of the company. So it's really important to me that at Montgomery Investment Management, we focus on businesses with high rates of return on equity. It's that simple. Now, people can tell you, oh, you've got to be careful about return on equity because of this reason and that reason, and it's true. You want businesses with little or no debt. You want businesses that generate strong cash flow, but you have to have businesses with high rates of return on equity. Okay, so that's the next thing. We're also after significant discounts to intrinsic value. We use return on equity to work out what a business is actually worth, its intrinsic value. And if I can use my glass, if you imagine, actually I'll use a bank account. Imagine for a moment we have a bank account with $10 million in it. So we'll call it Roger's special bank account, because the government has given me, because of my work, they've given me special dispensation to earn 20% on this bank account. So they're paying me 20% on this $10 million bank account. I'm going to put this bank account up for auction. I'm going to auction the bank account. It's got $10 million of equity in it, earning 20% a year. I'm going to put it up for auction. Would it sell at auction for more than $10 million? It's earning 20% a year. $2 million is coming out of this bank account every single year. If it was auctioned, would it go for more than 10 million? Yes or no? Yes. So it would sell for more than the equity in the balance sheet. The balance sheet has $10 million of equity, it's earning 20%, the return on equity is 20%, put it up for auction, put it on a market, put it on the stock market, it's going to sell for more than the equity, more than the $10 million. Now, quick arithmetic question. If there was $10 million of equity, 20%, it's earning 20% a year, $2 million coming out, and an investor wanted a 10% return on their money. So they want to invest some money and get a 10% return from that $2 million. What would they pay for that bank account? Who says $20 million? Yep, $20 million. So if an investor came along and said that they were happy with a 10% return on their money, there's $2 million flowing out of this every year. So you divide the $2 million by the 10%, you divide the return on equity by the 10%, you multiply it by the money in the bank account, and you end up with an intrinsic value of $20 million. So you'd be prepared to pay 2 times the equity of the business for a business that's earning a 20% return on equity. And that's the basic way, for that example, that's how we calculate the intrinsic value of a business. Exactly the same way. Now I can see some of you shuffling in your seats, scratching your heads and thinking, how do you do that? Well, I'll give you the formula, you can write it down. It's return on equity divided by required return. So that's 20% divided by 10% multiplied by the equity per share. In this case, there was only one share. I owned the whole thing and it was $10 million. So 20% divided by 10% equals 2, multiplied by $10 million equals 2 times $20 million, which is 2 times $10 million, which is $20 million. Okay, and that's the basic intrinsic value formula. Now, a bank account that earns 20% but pays no interest out, it retains it all and compounds it each year, that's going to be worth something more because it's compounding at 20% per year. So it's worth something more. Okay, provided of course it continues to get 20%. If it doesn't keep getting 20% because the manager of that particular company goes and pays too much for an acquisition, or they go and renovate their bathroom with shareholders' funds, that's not good. You're not going to get 20%. So I'm assuming that you're going to keep getting 20%. And if you keep getting 20%, well, it's worth considerably more than the first bank account, which was paying all of the earnings, all the interest out. Okay. We're also looking for businesses where that intrinsic value is expected to rise each year. The problem for ABC learning centres, which I describe in my book, was that return on equity was declining. Even though profits were growing, return on equity was going down, to the point that a couple of years before the collapse of ABC, the return on equity was less than what you could get in a bank account. The return on equity, think about the risk of running a business. Would you invest $1 billion in a business and have it run by someone else if they told you that the best return you're going to get is less than putting the money in a term deposit? You probably wouldn't. It's too risky. So we're looking for return on equity that's going up. We're looking for companies whose intrinsic value is going up. And I'm going to show you some examples of that today. Now, the important thing is that those future intrinsic values, the ones that we estimate, and I was the first person in Australia to bring the idea of future intrinsic values to investors' minds. There's a little excerpt, a little tiny paragraph where Warren Buffett talks about it 20, 30, 40 years ago, where he talks about businesses whose intrinsic value are rising at a satisfactory rate. And I started to investigate that, talked about it in the book. And we were the first ones to bring that in Australia, and it's very, very important for us in our investing process. But those intrinsic values are based on forecasts. They're based on estimates of the future performance of a business. So we think we're going to be wrong with our forecasts. We don't expect to be right. But what we know is this: the market, the stock market, is very inefficient. Very inefficient. It gets it wrong when it thinks about 2 years out. So when analysts are thinking about what a company is going to earn in 2 years' time and what their performance is going to be in 2 years' time, they tend to get it very, very wrong. And for that reason, I think there's a terrific opportunity if you can get it even remotely right, or conservative and wrong and the shares are still cheap. That presents a fantastic opportunity. So what we do is we look at our forecast, we look at our intrinsic values 2 years out. We ask ourselves, what will our return be if that's a conservative, maybe wrong, but conservative valuation, and the share price is down here today, what return will we get if the value goes up by that amount? So we're interested in rising expected intrinsic values. And the last point shouldn't be the last point. It probably should be the first point. Strong cash flow. I'm going to show you some examples of this today. Okay. So here is an example of a company that is very high quality. It's ARB. It's the biggest manufacturer of bull bars for four-wheel drives in the world. And if you're thinking about a store rollout policy, I'm just going to move those, bear with me. Can you hear me better this way? Is that better? Okay. If you're thinking about companies, retail businesses, if you like, it's a manufacturer as well, but retail businesses with store rollout potential, this is the biggest manufacturer of bull bars in the world, and it only has about 43 stores in the world. So I think it has remarkable store rollout potential. A fantastic opportunity. Compare the quality score for this company going back a decade to one that you're probably more familiar with. This is a company called Lend-Lease. For us, this is not investment grade. That is not what we're looking for. We're looking for ARB's profile, its quality profile, not this profile here. C4, C3, anything with a C in front of it, we don't invest in. Does anyone own shares in Lend-Lease? Hands up. Okay, a few of you. Hands up if you own shares in ARB. A few more of you. I'm delighted to hear that. Okay. By the way, again, that's not a recommendation to go out and buy ARB and sell Lend-Lease. The next thing that we do is we have a look, and you can see there's three buttons up the top there. You can see the quality score and the performance score first. Then we can see the historical performance of this company in terms of its intrinsic value. Remember earlier I said we want to buy businesses whose intrinsic value is going up each year. We want a business that's increasing. The National Australia Bank has not increased its intrinsic value over the last 10 years because of expensive forays into the UK, which is what I was talking to Tikki Fullerton about last night on the business on the ABC. Qantas has not increased its intrinsic value over the last 10 years. Telstra has not increased its intrinsic value over the last 10 years. If you believe long term that price follows value, then you need to buy businesses whose intrinsic value is going up. ARB's intrinsic value has risen, we estimate, by 17.4% a year over the last 9 years, and it's forecast to rise by about 14% a year over the next 2 years. That's what that blue column is. Sadly though, its price is currently a little bit expensive compared to its intrinsic value. And that's why you can see there's a red column over on the right-hand side for the safety margin. There isn't a positive safety margin there at the moment. Okay, now, here's how we think. I want you to take off your stock market hats. Forget about shares completely. Imagine for a moment you are going to write a cheque to kick off a business. And I'm going to run it for you. I'm going to run it for you for a period of years. But it's your money. You literally pull checkbooks out of your pockets and you write cheques to kick this business off. And over on the left-hand side, you can see on that screen a breakout box or a pop-up box. And I'll tell you what you're looking at there. You're looking at a company that's listed on the Australian Stock Exchange. It's Qantas. The red columns that you can see are the debt in the business. The grey columns that you can see, the grey columns there, represent the money you've put into that company. That's the equity that's been contributed by you. Okay? So that's the grey columns. The blue line is the return on equity. When we're looking for return on equity, what are we looking for? High or low? High. And stable ideally, or rising, not falling. We don't want falling return on equity. That's the blue line. And the green line that you can see is the reported profits of the company. Okay, now knowing all that, let's go over to the pop-up box over on the left-hand side. You've written cheques, you've contributed $4.2 billion to kick this business off, and I'm going to run it for you. And we go down to the bank together and we borrow $4.4 billion as well. Okay, so it seems like a lot, doesn't it? We'll forget about that for a moment. I now run the business for a year, and at the end of the year, I report a profit of $439 million. You can see it there, it says profit after tax, $439 million. Now that's an 11.4% return on the money you contributed. Is that good or bad? That's pretty good, isn't it? So it's not bad, it's better than you can get in a bank account. So you're encouraged by those early results, and you decide to keep running the business for another 10 years. Fast forward to 2011 from 2002, and the business is now earning $307 million. It's earning less than it was earning in 2002. Is that good or bad? Bad. Is anyone uncertain about that? No? Okay, good. All right, so earning less, if I said to you, if I had an information memorandum for a business, and I said to you, you're going to put $4.4 billion into this thing, and in 10 years' time we're going to be earning less than we're earning this year. Would you think that was good or bad? Bad. You wouldn't invest in it. But what if I then told you not only has the profit gone down, but the money you've put in has gone up? You've put more money in. You've now contributed $6.1 billion. So the profits are going down, and while the profits are declining each year, you're reaching into your pocket with your checkbook and writing out additional checks for more capital. Is that good, bad, or terrible? Terrible. And then what if I told you one more thing? One more thing. In addition to the $4 billion of debt that we borrowed in 2002, we've now borrowed $6 billion as well. So we've got more debt, we've contributed more money, and we're earning less. Would you want to own that business? Yes or no? No. So what this screen does is gives you a snapshot of whether you'd like to own the whole business. And that chart is converted into plain English by the computer at the top. So I can see exactly what's going on by just reading it. It says at the top, since 2002, Qantas's profits have declined by 3.9% per annum from $439 to $307 million. To generate this $132 million decline in profit, shareholders have put in equity of $1.78 billion and left in profits of $254 million. The computer just reads that chart and converts it into plain English. Would you want to own that business? No. Warren Buffett has a neat little quote, and this is the quote that I think suddenly this makes a lot of sense. If you're not prepared to own the whole business for 10 years, don't own a little piece of it for 10 minutes. Would you be prepared to own all of this for 10 years? No. Should you own the shares? Oh, maybe they might be going up. You see that what happens is the nexus between the business and the shares has been broken. Because you only need to buy a few little shares and you only need to put a few $1,000s in, they might go up and you might make some money. It doesn't matter how the business is performing. And what I'm suggesting to you is let's think about the business. You wouldn't want to own that business. Okay. This is a profile, and I've deliberately left the words off so you can't read it. This is the capital history and debt history of Telstra. And what do you notice about it? Is there anything that stands out to you? The debt is higher, or if you like, the debt has replaced the equity over the 10 years. If you look at 2011, compare it to 2002, they're about the same in total, but they've changed. There's a little bit more debt. What about the profit line, the green line there? Has that been going up? Steady state. Telstra has enjoyed mobile phone subscriptions in Australia. 10 years ago, there were 8 million plans. There are now 22 million plans. Massive growth in mobile phones. Internet in the home in Australia 10 years ago was probably 45%, 40 or 45%. It's now over 90%. Telstra has had business interests in both of those markets, mobile phones and internet. Subscription-based television, pay TV, didn't exist 10 years ago. It's now in 45% of homes in Australia. Telstra has had an interest in that business. Despite all of that growth, its profits in 2014 are forecast to be no higher than 2002. But everyone's talking about Telstra and the NBN, and the shares have gone from $2.60 to $3.50, and the yield's fantastic because that 28-cent dividend is going to be maintained. And they've got $11 billion in present value cash coming into their bank account. And isn't that all really interesting? But when I stand back, I ask myself the question, is this business going to earn a lot more in the future than it's earning today? And the answer to that question is basically no, or it's certainly not forecast at the moment. Okay, keep that in mind. Okay, the other thing that I said, so that's a summary of one of the things that we're looking for. That Qantas example that I gave you, that's how we think about businesses. Would we want to own that business entirely? The other thing that we want is strong cash flow. This is a business called Embleton. I don't know if you've heard of Embleton. Hands up if anyone's heard of Embleton. 1, 2. Hands up if you heard about it before I mentioned it. Yeah, okay. Right, very good. Just checking, you're on the ball. There was a terrific study done in 1996. Attendees to workshops and seminars absorb and retain more information if they're awake. Okay, so I'm delighted that you're participating. This is a company that manufactures in Australia and distributes hardwood flooring. Okay, the stuff under your feet. And also underfloor suspension, if you like, underfloor suspension. And it's a small business. Many of you haven't heard of it. It's run by a third generation Embleton, and it's been growing over the last 10 years. It's grown its profits every year. You can see those green columns They're green because they're higher than the previous year, each year. It's been growing its profits every year. The dividends have been going up generally over that 10-year period. The blue line that you can see there is operating cash flow. Generally, that's been going up. You know, that waves about because they need to commit to making some spending decisions and investment decisions in their business. So it goes up and down, but generally it's been going up. And then the other thing that you'll notice is the green line. The green line at the bottom. That's the cash funding surplus or gap. So what that is that's what's left over after the company spent all the money on running the business, after they've invested some capital back into the business, and after they've paid dividends. Is there any money left over? That's what that line is. And we want businesses where that line, that green line, is most of the time above zero. It's above that horizontal, the middle line, in the middle line there on the screen. We want a business that's growing its profits, cash profits and surplus cash every year. Why? Because companies that throw off lots of cash can do good things with that cash. They have the ability to buy back shares if their shares are cheap. They have the ability to make special dividends. They have the ability to make sound acquisitions if they've got organically generated excess cash. That's the sort of business we're after. Have a look at the cash flow of another business that starts with E, not Embleton. Oh, by the way, let me tell you a quick little story on this company. I wrote this up for a newsletter, and I wrote it up in the newsletter in a particular week, and I talked about the company and what it does, and it's great, not great prospects, but it's great financials, and then I said I want you to guess the company. And the next week I got a phone call, and a gentleman rang me, and he said, "Mr. Montgomery, hello. I just wanted to let you know I think I know what company it is you wrote about. I just wanted to let you know I'd like to make a guess." And I said, "Well, okay, great. What company do you think it is?" "I think it's Embleton." "Really? How did you know that?" "Because it's my company. I'm George Embleton." So I was absolutely delighted, and they are for the last 10 years that's in that review period. They've been running a very sound ship, and I suspect they are delighted that we discovered the company, but at once not so excited that we discovered the company because now other people have discovered it as well. This is another company starting with E. It's called Elders. Have a look at that green line. Now, that green line is mostly negative. That means a company, when that green line is negative in scaffold, the company has to do one of three things. It needs cash. It's got a shortage of cash. It means that its operations haven't generated enough cash to pay for its dividends and to pay for the investments that it's made. So then it's going to need to do one of three things. Raise capital, which will dilute your ownership in the company by issuing more shares. It's going to have to borrow money, which increases the risk, or it's going to have to dip into its bank account if it's got cash in the bank account. But if it's doing that regularly, there's not going to be a lot of cash left in the bank account. So we try and avoid businesses that look like that. So even though it might be an A1 company, and even though it might be cheap, if the cash flow looks like that, we don't buy it. A1 means it's not going to blow up. It could still be A1, not blow up, but have poor cash flow. And eventually that A1 quality score will deteriorate over time if the cash flow stays like this. Is there a relationship, though, between poor cash flow and share price performance? Can anyone tell me what's happened to Elders' share price over the last decade? Does anyone know? It's ditched. Yes, which is a technical term, meaning it's gone down. Yes, you're absolutely correct. It's ditched. Okay, I like that. Do you mind if I use that myself? Thank you very much. Okay, a small fee. Okay, all right, we'll talk about that at the end then. All right, so and I will charge you a small fee for the stuff you learnt today as well. Okay, so very important that we have positive cash flow. Okay, so that's I guess that's the understanding what sort of businesses to buy part of the presentation. Now what I want to do is I want to find out whether or not there are any stocks that are actually cheap in the market right now. Is there anything that looks like we should be investigating it further? Remember, it could be cheap, but it may not be great quality. It could be cheap, it may be great quality, but it may not have positive cash flow. So there's some more work that we need to do. what we do in Scaffold, and what we did this for ourselves at Montgomery Investment Management, is we aggregated the intrinsic values and the forecast intrinsic values for the biggest 200 companies to come up with an intrinsic value estimate of the stock market. Now, some of you said you thought the stock market was cheap. Well, based on 2012 estimated earnings, it looks like it's a little bit expensive. See that line over 2012, and you can see the All Ordinaries Index, the ASX 200 is slightly above that yellow line. You can see that at the moment. Well, that's telling me that based on 2012 results, the stock market actually seems to be a little bit expensive. Again, remember, this is not a forecast about where the stock market's going. It's just saying that it seems to be a little bit expensive. Okay, but if you look at the 2013 estimates, so based on estimates of intrinsic value, which are based on return on equity for 2013 for the biggest 200 companies, the intrinsic value for the All Ordinaries, for the ASX 200 is going up, such that at the current price, based on 2013 values, the market seems to be reasonable value. Not bargain basement, but not expensive. It seems to be about right. So the market at the moment, in my estimation, is neither particularly expensive nor particularly cheap. So you'll hear people coming out and saying the market is expensive and we're expecting a correction. You won't hear that from me. You hear other people saying the market's a bargain and it's going to surge from here. You won't hear that from me because we simply don't forecast where the market's going. But I think the market seems to be about fairly priced. So that means to me it's worth investigating a bit further. It's worth looking for some opportunities. Here is an example of the intrinsic value of a sort of business that we're looking for. This is ARB. Remember I showed you ARB before. It's been an A1 or A2 quality company for the last decade. Have a look at what's happened to its intrinsic value over the last 10 years. On a net basis, on an aggregate basis, it's been going up. And that's what we're looking for. Businesses whose intrinsic value is going up, very high quality, generating positive cash flow. Okay, so each one of these dots represents a listed company. The ones on the left-hand side are poor quality. The ones here, C5, C4s. The ones on the right-hand side are better quality, A1, A2, and so forth. The companies, the dots above the line, have a positive margin of safety. They're the companies that are trading at a discount to their intrinsic value. If you like, the intrinsic value is above their price. So they're at the top half of the screen. The dots, the spheres below the horizontal line, they're trading at a premium to their intrinsic value. Their intrinsic value is less than their current price. So they're in the bottom half. But that's all the companies. I don't want all the companies. I just want the good ones. So what I've done is I've opened up the filter panel and I've just selected A1s and A2s, and you can see that on the left-hand side there. I'm looking for A1s, A2s. I'm looking for companies trading at a large discount to their intrinsic value. I'm happy with large caps, mid caps, small caps, micro caps and nano caps. Happy with all of those. And I'm interested in any sector of the economy and the market. So basic materials, capital goods, conglomerates, consumer cyclicals, consumer non-cyclicals, energy, financial stocks. I'm interested in all of them. I'm just going to remove listed investment companies. I don't want to invest in someone else's investment strategy. I want to invest in businesses, operating businesses. So I'm going to just rule those out for the purposes of this screen. And then if I then click apply, all those dots disappear and only the ones that meet the criteria that we've just described come up on the list. And what we're going to do is we're going to drill down and look at some of these dots in a little bit more detail. And when I do that, I use what's called the table view. You can see it over on the right-hand side. So I've selected the table view, and ladies and gentlemen, what I've done is I've taken those companies, there are about 50 of them all up. In total, there are about 50, and I narrowed them down a bit more. And I did this. I looked for companies that have net cash. I looked for companies whose forecast earnings per share was for growth. I looked for companies whose historical forecast change in intrinsic value was positive, and I made an exception for a couple. I'm looking for companies with high rates of return on equity and looking for companies with a safety margin. And when I go through and narrow down the universe of companies that meet that criteria, bear with me, I come up with this list. You can see it here on the left-hand side. Now, for those of you who are interested, the very top one is called Black Gold International. Do not, under any circumstances, rush out and buy these stocks. Actually, I'll tell you which ones I do want you to buy. I want you to buy Seymour White and Flight Centre because I own them. Clearly, that's ridiculous. Do not take me seriously on that. You would be helping me, not yourselves, if you went out and bought those stocks. Bear in mind, I own some of these shares. So if I'm encouraging you to buy them, I'm helping myself. You must do your own research or speak to your personal professional advisor and make sure that any of these companies suit your financial circumstances and needs. Okay, so what are some of the companies? Well, Black Gold International appears to be a Chinese-based and Chinese-run coal explorer and coal producer. Iluka Resources, I'm sure you'll know. Mount Gibson has come up, but Mount Gibson has mine life issues. They have a mine life issue. They've got a mine that's only going to run for another 2 years. They have to do something with that money. What are they going to do with that money? We don't know. And because we don't know what they're going to do with that money, we don't know if they're going to acquire another mine and what price we're going to pay, what the price they're going to pay for it. Well, it's very hard to work out what the real intrinsic value for that business is a couple of years out. Flight Centre, I'm sure you know. Okay, Flight Centre, I'm sure you know. That's popped up on the list as well. Norfolk Group is a contracting business, engineering contracting business. Seymour White, we have owned shares in Norfolk in the past. Seymour White is a civil engineering business based in Queensland. So they're building roads and bridges and those sorts of things. And Macca is a mining services business. Now, very interesting. About 3 or 4 months ago, when I ran this particular scan, there were a whole bunch of mining services companies that came up on the list. And I started to get very nervous. You might have become really enthusiastic. We've owned mining services companies for a year, almost a year. And when we started buying mining services businesses when we thought they were cheap, nobody was talking about them. The brokers weren't covering them. There wasn't a plethora of mining services analysts. And since reporting season, the half-yearly results, brokers have been calling us and saying we'd like to come over and talk to you about the mining services sector, and we're bringing our mining services analyst. They didn't have a mining services analyst a year ago, and now everyone seems to have a mining services analyst. On my blog, and my blog address is blog.rogermontgomery, you don't put www in, just blog.rogermontgomery.com, we write about what we're thinking about at the time. And I wrote about mining services, and I put a photograph up there, and it was a train in Pakistan. And there's no room inside because of all the people. So the people are on the roof, and they're on the outside, and they're on the front, and they're all dangling all over the train. And it's a crowded carriage. And I'm just cautious about mining services, that there's a lot of recommendations going around to buy mining services at precisely the time that there might be pressure on iron ore prices and coal prices. So precisely when everybody's getting really enthusiastic about mining services, the commodity prices that drive the development of new projects that mining services companies help develop, those projects may slow down if the prices of those commodities continue to fall. Okay, so keep that in mind. So I'm going to finish up now. We've gone just a fraction over time. I'll be outside to answer your questions, but what we've done today is we've done 3 really important things. Number 1, we've come up with a structure, a framework to think about investing. Number 2, we've looked at the key things that you should look for in a quality business that is also good value. So we've talked about the intrinsic value formula, the basic formula. We've also talked about standing back and thinking about whether you would like to own the whole business. And finally, what we've done is we've had a look at whether or not there's value in the market at the moment. And interestingly, when we look at very high quality companies, 7 things came up that might be worth some investigation. I'm going to finish up there. This will be the last time I present live in Melbourne to you. I will miss seeing you, but I'm sure I will see you again in some other environment and some other medium. You'll certainly see me online because I'm going to be participating in those online seminars. Thank you very much for your attendance today.